Hello and welcome to our continued discussion of PepsiCo's 2014 annual report. This video will discuss its long-lived assets, including property, plant, and equipment, and intangible assets, using the indicator of asset turnover and using the ratio return on assets. So we need to dig deeper within PepsiCo's 2014 annual report for more information about long-lived assets. We need to look at its balance sheet on page 71 of the 10K, in the footnotes, notes 2 and 4, and in management's discussion and analysis which precedes the financial statements on page 44. I've excerpted the balance sheet, the asset side of it. Remember, assets are $70.5 billion at the end of 2014. A decent amount are property, plant, and equipment, which are tangible assets used in operation. That's $17.2 billion. We have a little bit of what's called intangible assets that are amortizable. So there's $1.5 billion of intangible assets with limited lives that we amortize, and a whole lot of non-amortizable intangible assets, most of which are goodwill. Remember, intangible assets are rights and privileges that a company purchases. So in order to explain them, we'll dig into the footnotes. Footnote 4 begins with more details about net property, plant, and equipment. The net number from the balance sheet is $17.2 billion, and we want to explain that. What types of things are in here? Land, buildings and improvement, machinery and equipment, which include the fleet, the delivery trucks, and software, and construction in progress with an original cost of, so the total original cost of property, plant, and equipment was $36.3 billion. Because these items have useful lives, they wear out, we depreciate them using the straight line method to depreciate their cost and charge them to the income statement over their useful lives. The lives range from 5 years for machinery and equipment to 44 years for buildings and improvement. And over the life of these assets, we have already depreciated $19 billion against the cost, deducted from the cost of $36.3 billion, leaving us with $17.2 billion, the net amount on the balance sheet. If we want to find out how much depreciation expense is in the income statement, it's usually buried within the selling, general, and administrative expense. It's $2.4 billion. We have a small amount of amortizable intangible assets. These are rights, privileges, and competitive advantages. We own long-lived assets that these rights are not things we can touch physically, and these are the ones that have lives that we can estimate, that we don't expect them to last indefinitely or for a very, very, very long time that's hard to estimate. Overall, on the balance sheet, we have net amortizable intangible assets of $1.4 billion. Well, what are they? Franchise rights, which is rights to distribute products within a territory, some of which they acquired from other companies. Sometimes they reacquire it. Brands that they've purchased either within an acquisition or brands that they purchase separately without purchasing the whole company, and other rights and privileges. The original cost of these are $2.942 billion. Everything is amortized using the straight line method, and really there's only a little bit. It only had a little effect on the income statement, and it was listed on the income statement at $92 million in 2014. The much larger amount is for the intangible assets with indefinite lives. Because we're not sure what the life is, we just want to make sure that we're not overstating it. So we're not going to amortize or charge their cost to expense, but we have to test it to see whether it's impaired. These consist mostly of goodwill, franchise rights, and the net balance is $27.6 billion at the end of 2014. Okay. Note 2 says we test them for impairment using a qualitative or quantitative approach. We do it annually in the third quarter. And for the brands, these are brands that they purchased either as part of an acquisition or just brands that they purchased separately. For instance, buying the right to Doritos, you might say, well, how do I know how long that brand is going to be valuable to me? We just want to make sure we don't overstate it, so we need to test it for impairment. I want to point out that goodwill, this $15 billion worth of goodwill, has a very specific definition in accounting. This results only when one company acquires another and the purchase price exceeds the fair market value of all the individual net assets of the company acquired after settling its liabilities. So PepsiCo a long time ago bought Frito-Lay. They would say, what are all its assets worth today, including its brands like Doritos or Lay's potato chips, deduct the cost, or not the cost, of the value of the liabilities, and if they paid more than even the individual assets and liabilities, that's called goodwill, the price of having the control of the business as a whole, which operates together as opposed to just buying separate pieces of it. If we want to analyze assets with ratios, one is an efficiency ratio, asset turnover. We need this year's income statement and this and last year's balance sheet. Notice overall that PepsiCo has a little bit more sales, and just eyeballing it, wow, assets went down at the end of this year compared to last year, and the two numbers for assets in 2014, if we average beginning and end of year, seem like they would be less than they were in 2013. How did I get assets in 2012? I got it from the 2013 annual report. I don't expect you to do it for your company. Asset turnover is 0.9 times in 2014 versus 0.87 times in 2013. Let's try to put this in English. In 2014, PepsiCo generated 90 cents worth of sales per dollar of average assets invested. Higher asset turnover means more efficient use of assets to produce sales. Using asset turnover, PepsiCo was more profitable in 2014 than in 2013. You'd rather generate 90 cents worth of sales per dollar of assets invested than 87 cents. Continuing our analysis of assets with ratios, let's look at return on assets, which says how much net income do you generate for your average assets invested. If we just look at PepsiCo's income statement, we need this year's and last year's net income. PepsiCo has a little bit less net income this year, but they used a little bit less assets to generate it. So better income, worse income, less average assets. Let's see whether having higher asset turnover leads to more profits per dollar of asset invested by looking at return on assets. So we look at net income divided by average total assets. You'll need this year's income statement and this and last year's balance sheet. PepsiCo generated less net income this year than in 2013, only $6.5 billion versus $6.7 billion. But it looks like that they had less average assets in 2014 than in 2013. In 2014, PepsiCo had a return on assets of 8.8%, meaning it generated 8.8 cents of net income per every dollar of average assets invested. Higher return on assets indicates more efficient use of assets to generate profits. Using return on assets, PepsiCo was less profitable in 2014 than it was in 2013. It only earned 8.8% versus 8.86%. Let's explain return on assets with profit margin and asset turnover. Return on assets we defined as net income over average total assets, but we can break it down to understand why one number is higher than another by breaking it into profit margin times asset turnover. Profit margin is net income over net sales. Asset turnover is net sales times average total assets. So, PepsiCo, in a prior calculation in an earlier video, had a lower profit margin in 2014, only 9.8 cents per dollar of sales, or 9.8%, versus having a profit margin of 10.1% of sales in 2013. Lower profit margin, but a higher asset turnover in 2014. And if we talk about how they interact, PepsiCo had a lower of return on assets in 2014 compared to 2013. So the lower profit margin more than offset the higher asset turnover. So just because one company is better than profit margin, another company's better in asset turnover, we need to interact or multiply them to understand the effect of return on assets. So this concludes our long-lived assets, asset turnover, and return on asset video. Please feel free to use this presentation as a review before finding the long-lived asset disclosures and calculating asset turnover and return on assets for your chosen company for 1 year. Discussion will help you compare your company to another in a different industry. Good luck and get started, Jaspers.